Hi everyone, welcome to the Timing Research Show for May 31st, 2016. Today we will be talking about the 140th weekly report from Timing Research. So if you haven't had a chance to take a look at this yet, just go to TimingResearch.com and you can download this or any past report there. My name is David Kosmeter, I'm the creator of Timing Research, and today I have Matt Buckley back to moderate. So I'm going to go ahead and turn the show over to him.
Thanks, David. I appreciate it. Welcome aboard, everybody. As David said, my name is Matthew Buckley. My call sign is Whiz. We'll get into that in a couple minutes. Hopefully you had a relaxing 3-day weekend this past weekend, and hopefully many of you spent at least a portion of yesterday remembering why it's called Memorial Day. It's not National Barbecue Day or National, hey, I got the day off from work day. It's Memorial Day, and you actually spent some time reflecting. I spent I spent 15 years flying fighters for our country, for the United States Navy, and missions over Iraq, and lost 11 really good guys. So that's what I spent yesterday doing. Wasn't barbecuing. I was remembering that they're never going to see their wives and their parents again. So hopefully you spent some time at least thinking about that. But let's pick up some airspeed and get airborne here. I'm very proud to host once again this week. Our guests include Anka Metcalf of TradeOutLoud.com. James Ramelli of Alpha Shark, always great to hear from James. 500-pound head in the options industry. Taking a look at that order flow, which is very, very critical. And then we have a great professor, literally from Option Professor Jim Kenney, another 500-pound brain in the options community. So, folks, let's just keep that batting order, so to speak, throughout today when we're talking and answering questions. So, Anka, why don't you give everybody a little bit of an executive summary about who you are and what you do, and obviously where you're coming from.
Hi, everybody, and thank you so much for having me here on the show today. So my name is Anka Metcalf, and I have been active in the trading industry since 2003, but my career started well before that. My trading career started well before that, but since then, I've been an independent professional trader. I trade stocks, futures, and Forex. Day trade and swing trade with very minimal investing for the last 4 to 5 years in the market. And I'm also the founder of Trade Out Loud, which is a trading education company that was born in January 2011. And it specializes in complete trading education for active traders for equity, Forex, and futures.
Okay, great, Anka. Looking forward to hearing what you have to say about all of our respondents' answers, and also what you think's going on in the market today. So looking forward to that. James, how about yourself?
So as Matt already kind of alluded to, we are mainly focused on equity options here at Alpha Shark. We do have coverage areas that look at futures and individual equities, but my main bread and butter is equity options, specifically looking at equity options order flow from institutional traders. So I think that's one of the most important things that any retail trader can do, is spend some time to sift through the large block trades that hit the tape in a day in the equity options market, because it really is kind of the last place that institutions are unable to hide their order flow using dark pools or other centers of off-exchange liquidity. So we'll be talking a lot about that today. It's kind of what I base all of my trade setups on. And then I also do focus on some equity options trade setups ahead of catalysts like earnings and individual stocks.
Awesome, perfect. And Jim, tell us about your background and what you do at Option Professor.
Okay, Matt. I provide the content for the Option Professor DVDs. They're educational DVDs, so they're not anything that has to do with making picks or anything in the market. But they do help you with the understanding on how the different strategies work, the uses and the risks of the strategies, buying and selling calls and puts, rolling them up or down, doing spreads like calendars, debits, and credit spreads, and what the use and the risk of the tactic is, and then hedging tactics such as married puts and collars, which from time to time can be an effective way of protecting some of your assets. So there is a lot of different moving parts in the options, and and a lot of different strategies to consider. So what Option Professor tries to do is give you a good idea on how the plays work, and then you take the plays and do whatever you'd like with them.
Okay, great. My name is Matthew Buckley. Call sign is Whiz. As I said, I flew fighters for the Navy for about 15 years. I taught myself how to trade equity options in the early 90s, and I applied everything that I was learning flying a fighter aircraft to my trading, because at the end of the day, when you think about it, trading is a form of combat. Somebody's going to win and somebody's going to lose. And if you think that Wall Street or a market maker or just the entire market's going to take it easy on you because you're, hey, well, I'm just a little, mom and pop trader in Poughkeepsie. Well, it doesn't matter. The market will steamroll over you. Having a strategy, implementing tactics, contingency planning, debriefing, asking what if could go wrong during a trade before I even get in the trade, so I know what to do and take the emotion out of it. So it was an absolute blast. Using all those methodologies, I popped up on the radar of one of the largest volatility arbitrage firms in the country, equity options vol firms, Peak 6 Investments, headquartered right there in the Chicago Board of Trade, and became their managing director of strategy for about a year and a half. After that, I moved on to become the founder and CEO of the Options News Network, ONN.TV, and had an absolute blast. We helped build Options House and a hedge fund when I was at Peak 6, and then I decided that Chicago winners were best left for suckers other than me, and moved down to beautiful Boca Raton, Florida, where I am very, very happily sitting in 90-degree heat right now, which is awesome. Okay. So that is the four of us that you're going to hear from today, folks. Let's go ahead and bring the report up. David's got it down there. You can click on it and pull it up full screen if you want to see. Anka, we'll start with you. Based on any technical or fundamental indicators, or any indicators for that matter that you want to use, would you predict that the S&P 500 index will move higher or lower from today's open to Friday's close on June 3rd?
Okay, well, that's a very good question, and the only the only indicator that I use is price action. And judging by the current price action, I see that right now we're again up against into a lot of resistance into the S&P, and that is a lot of congestion. Now we have to factor the fact that we are into a bullish market. Nonetheless, we did manage this year to recoup the losses, and we're trading right into last year's range. So judging by what the price is doing and the fact that it's meandering around this $2,100 area, I think that the more we sit in this area, the more we will just build up enough energy to pop above that. So my bias for this week is higher. So I think there's a pretty good chance that the S&P 500 will probably try to blast off through this congestion area and probably reach, I would say, probably 2130, 2140 area. Probably is going to go for that area. And that would be my next resistance area that I'm looking at when I'm looking at the S&P. So again, my only indicator, it would be price action and what price action is doing at this particular time.
Okay, what was your take? Let's just debrief last week real quick. What was your take on what happened last week as far as price action?
As far as price action, well, it was very interesting because I do have a newsletter that I send out every week, and what I have stated in the newsletter and for all of our members at Trade Out Loud was actually a buy into this support area, into the Qs. Actually, for the Qs was a breakout. And it was hold on, let me just see real quick the chart so I could give you exact pricing of the call that we've made. Okay, so it was the long was over 107 and we had a price target of 111.
Do you want to share your screen? I'm not seeing it.
You're not seeing it. Let me see how I could do that. Hold on real quick.
Yeah, in the top left of the platform there's like a little green screen, it looks like, with an arrow to the right, and you can click on that.
Okay, hold on a sec. I'll get that ready. Hmm. Can you like guide me along the way one more time how to do that?
There's on the left side, when you move your cursor to the left
Okay.
side of the screen, there's this little menu that pops up, and there's a green button with an
Got
arrow.
it.
Okay.
Okay. Awesome. Okay. Cool. Let me know if you guys can see the screen.
Yeah, I can see it.
Yeah.
Awesome.
Yep.
All right, perfect. So actually was a call in our last week newsletter that is delivered each Sunday to our swing trading clients, subscribers. So this call was made at 107. So we took the cues long at 107, and we had a really tight protective stop at 106, and our target area was 110.50 and 111. So I think we just hit very, very close on Friday with so on Friday, I think we had a high of 110.11 or something like that. And today we did pop a little higher to 110.50, so right on target today. So we're still in this trade. We're managing the trade. So to go back and answer your question about SPX, S&P 500, yes, we are still bullish on it, and obviously SPX was much stronger than the Qs. And here I have applied a Fibonacci retracement, and as you can see right here, we had a lot of resistance. A lot of support into this 2050 fulcrum area. So from this point on, we did have a really full, nice blast all the way to the upside. Now here we have a quadruple top. So a very difficult area, but don't forget one thing, and I think that all of you can agree with me. Is like the more times we knock on the ceiling, one of these days we're just going to blast through it. So we're going to see if this is going to be the week that is going to, push that the price is going to get pushed higher or not. But my bias is that the way I see it right now, it's consolidating within this range right here. We're still trading within Friday's range, so we might have good odds of blasting through this area higher.
Interesting. Okay. Well, let's James. What's your take on this week at least?
Yeah, so I actually
Towards the
agree
end.
with a lot of what Anka just said there. I just don't think that this is the week that we necessarily have enough momentum behind us to push through the top of the resistance level that we're trading at now. I also see resistance in price action right around 2105-ish, which is just a little bit above where we're trading right now. If we take a look at the way we traded last week, I mean, Tuesday, Wednesday, Thursday, Friday, all up days, kind of unrelenting in the rally that we had there, and we're down today. With it being a shortened week, I just don't think that there's enough, traders at their desks to create the price action momentum to break through to the upside. And the options market is kind of confirming that as well. If we take a look at the implied move in the S&P futures, we actually had an expiration today, the end of month expiration, but there's another one on Friday, the standard weeklies in the SPOOs. If we take a look here, they're implying like 18 points worth of movement between today and Friday. And although that's a shortened week, that is not what we would expect the straddles to be priced at on Tuesday in a week when we also have the jobs number. So it looks to me that the options market isn't really expecting a whole lot of action. With that being said, I think that we're going to kind of trade sideways to slightly lower this week as we bump up against this resistance. And then maybe next week, once everyone's back from the Hamptons and we've got some action there, we'll see a move to the upside. Volatility is also not super high here. The S&P futures have the lowest average daily true range that they've had since like July of last year. So I just don't think that this is the week that we get our breakout to the upside.
Like the way that sounded. Jim, what do you think?
Well, I'm more on the camp of James's last remark. We ran up here to the 2105 ballpark area. My opinion and my view is that 2110 and 2135 are still intact, and those are important numbers. I'm a little concerned on a little bit of a sentiment thing that we may have bought the rumor that Q2 numbers would be improving, and then we might be selling off on the fact. The home sales were real good, wages were real good, consumer spending was real good, and we're down. So, I'm getting an idea here, and oil prices are up today, and the oil stocks are down. So I'm getting a little bit of a vibe that we bid this thing up on some good news, and now that some good news is coming out, we're kind of selling off on the fact. If by tomorrow we're not taking out today's high, I think the odds might improve that that's an accurate forecast. The other thing is the volume I'm looking at and the breadth, the new high list and all that. The new high list looks pretty weak, so the market breadth doesn't look that great. And the volume, if you look at the volume on some big stocks on a 50 and 200-day basis, the volume in the last 50-day average is much lower on some cases than the 200-day. And I'm talking about big names: Facebook, Google, Amazon, Starbucks, Apple, Johnson & Johnson, McDonald's. That's a pretty good range of different companies and stuff. And if you look at their 50-day average volume and their 200-day average volume, looks like volume's drying up a bit, and I don't see that as bullish. Oh,
okay.
So in summary, I think it might slide off between now and the end of the week.
Okay, so you're a slide off. That's interesting, Jim, because that's where I was going. And you hit on some of the topics as to why we kind of drifted up. Last week it was a week and a half ago, it was a couple of Fed lieutenants running around telling the market, like, hey, are you guys not listening to us? Sure, we can go up in June. And the market had a little bit of a tantrum, and then it kind of eased into the maybe we'll be okay if rates go up. We won't implode. So we had kind of that melt up last week, and we did have some good news. But as you pointed out, some of the data that came out this morning, it was a little bit of mix. I mean, especially the Conference Board's consumer confidence number, huge swing and a miss. And Chicago PMI, not that the Midwest just determines all that stuff, but it printed at 49.3, which, if just to school some of the folks who don't know, any reading in PMI above a 50 indicates expansion or good times, and anything below a 50 indicates contraction or potential recessionary conditions. So Chicago PMI was a miss. The Conference Board's consumer confidence numbers, big miss. But Case-Shiller looked good. Personal spending was up, which everybody started dancing around on Comedy Central, on CNBC. I call it Comedy Central. But when personal income was flat, we have a ton of other macroeconomic data coming out this week from, and tonight we're going to get some China data, manufacturing and non-manufacturing PMI out of those folks, which, as many of us know, if that's just absolutely horrible, we'll wake up tomorrow morning and see in red on the futures. And if you're under why, that's exactly why it'll be China. Final manufacturing PMI, ISM manufacturing on Wednesday, total vehicle sales throughout the day, and then Thursday, ADP, non-farm payroll, an ECB conference, and then we get a slew of macro data on Friday. What am I getting at? I think, and let me pull this up here. I just think that we are, to be honest with you, a little bit hypoxic, to steal an aviation term. So a little bit hypoxic up here. This is a hell of a run. We kind of slid through the 50-day moving average a couple weeks ago, not with a ton of airspeed. I mean, we just kind of stalled through it and then caught a bid. Serious airspeed through that 50-day. The market's going to give some back up here, period. I think we give a little bit back. I don't think we roll over. I don't think we hit the 50-day. I don't think, to steal a Fred Sanford-ism, this is the big one. But we're gonna pause here easily to take some profits. There are not a lot of, quote, smart people buying. Period. You hear, your Carl Icahns, you hear all these, quote, smart money folks who are getting net short. George Soros doubled his position, his bearish position in options on the S&P 500. He might be buying with one hand, but folks, he's buying a hell of a lot of protection with another hand. So I think we're actually lower by Friday. Not a hell of a lot. I don't think we implode, but I do think we head lower. And that is my 2 cents. So let's head over to question number 2. So Anka, rate your confidence in your answer. So you gave us some great data and pointed to some good stuff. What's your confidence on what you think is going to happen this week?
Well, the thing is that I take the market on a day-by-day basis, and overall, although I am bullish, I really wouldn't ignore the fact that the market is into resistance right now, and like I've mentioned earlier, it's into a quadruple top. If you take a look on a daily chart or even onto a weekly chart, and a retracement would be possible. A retracement would be possible. We're in a very bullish environment. Like you said, we are expecting some Chinese PMI data overnight. And we're just going to have to see how the futures are going to handle that data and how that's going to affect the market. But I think if we're going to get a pullback, we might get a pullback into the 2080-50 area, from which that would be an area where we can bounce again. So that would be my take. So I do have conviction that it might go higher, but again, I'm not ignoring the fact that it's into these highs right here. It's having a really hard time, and it's struggling. But at the same time, it's not hard selling.
Yeah, we couldn't see your charts if you're trying to show your charts.
Oh, okay. Okay, hold on. Okay, I think this is the screen. Okay. Let me know if you guys can see the screen. You guys can see it?
Not yet.
Yeah, I can see it.
Yeah. All right, awesome. All right, so I was talking about this retracement level all the way to 2070, 2075, 2080. So this would be my area here for a possible recoup and up to this resistance area back again. So we're going to see how the market is going to play out. So, and like you've mentioned, there are a lot of economic data. There's a lot of economic data that is going to influence. And again, we do have the OPEC meeting that is going on Thursday. So we're going to see if oil is going to participate again, and it's going to help the market either higher or lower this time. So we're going to have to see if they're going to be in sync or not in sync. Because we had like a really tremendous rally in oil. And we're just going to have to see if they're going to be, if they're going to be helping, if oil is going to be helping the market or not. So there are a lot of things that are going to happen this week. So again, I think that we should be extra cautious and take it one day at a time.
Okay, sounds good, James.
Yeah, so I'm pretty fairly confident that we're not going to manage to rip higher this week. Like I said, I just don't think the momentum is going to be in this market with the shortened holiday week. A lot of our customers were looking at the straddle in the SPY and the S&P futures this morning and saying, hey, wow, 18 points is super cheap considering all of this data. I mean, Matt, you just ran down the calendar for this week. It's nuts. Like, every 2 hours for the rest of the week, we're going to have some type of macro data release. But then again, none of that is being reflected in what the market makers are pricing into the options for this week, right? And I just don't think that we're going to have enough momentum. One thing that people always say, and Matt, I'm sure you've heard this a million times, if volatility looks cheap, it's probably going to get cheaper, and when it looks expensive, it's probably going to get more expensive. So I don't think that we're going to see just a huge expansion in volatility this week over what market makers are already kind of pricing into the market. And the fact that we couldn't manage to rally today, which is the first day of the week as we touch off of this resistance, I think is a pretty good indication that it's going to be pretty difficult for us to get there through the end of the week. And then also consider that even though expectations for movement this week are relatively low, a lot of those data points that you just talked about, Matt, that are coming out this week have not been all that great. We're looking at manufacturing and construction data. I don't think that that's going to be all that great or point to a bustling and strong economy. We also have Beige Book on Wednesday, which will give us a pretty broad swath of a lot of indicators of where we stand right now. And the jobs number, I don't think is really going to be that significant of an event. So, with all of that, I think that I'd probably say I have about an 80% confidence that we end up lower by the end of the week.
Yeah, I agree, James. These jobs reports are getting less and less significant. It's not like the Bernanke era where a jobs report determined whether or not he was going to start the taper or this or we get more So now it's a foregone conclusion that we're going to get some serious interest rates, unless it's a stupid blowout number. What was that, like a year Whenever that was, I remember looking at jobs report come out one day, and it was 85 grand, and we all kind of looked at each other like, is there a one missing? And there it wasn't. It was 85,000 that one time. So unless it's a complete stupid blowout to the downside, I think you're right. I think it's a non-event because I think the interest rate increases are kind of baked in. So I agree.
And it can happen the other way too, right? I mean, if they come in with a just absurd, enormous number, well, then the entire market is going to have to completely adjust their expectations for whatever the quote unquote pace that they have in their minds and now for the rate hike would be. But I mean, again, and I think that looking at what market makers are pricing into the futures at the beginning of the week is always a really good indication of how likely something like that is to happen. And I think they're saying almost no chance this week.
Yeah, I'd agree with that. Okay, Jim, what's your take on your probability?
Yeah, we were talking about, I was talking about the potential of it possibly sliding off, and I'd go probably 60% on that because you never know in these markets when something's going to come out of the blue. But I did want to bring up a couple things. One is that we're now in June before you know it, and then that's going to be about 6 months before the election. A lot of people sometimes say that the market is in a 6-month discounting mechanism, and so that means the election, when these people come back from wherever they are and they want to make decisions, they may be starting to focus on what will this market and world look like as we go into this new presidential thing. And if they are concerned, sometimes people take shelter when they're concerned. So the other thing you guys mentioned was China's got some numbers coming out, and I was reading how the debt to GDP on China is like 237%. And this Goldman Sachs analyst was saying that that type of relationship, like in Japan, generally leads to a crisis of some type or a prolonged slowdown. So expecting tremendous numbers out of China may not be the way to go. So it'll be interesting to see what happens. And later in the month, you've got the British talking about leaving the EU or not. And some of the polls they took show that people are favoring to leave, but then the bookmakers over in London are saying it's a 75% chance that they won't leave, and probably the bookmakers is the better way to go.
Yeah, no kidding. That's a great point. Okay.
I have a comment on that real fast.
Go ahead.
I watch some of the prediction markets, and Predicted.com is showing 71% chance of right now of them not leaving. So I want to throw that in there.
That's pretty high. That's a high level of certainty there. Good points, Jim. I'm about an 80 delta that we're lower by the end of the week for a lot of the reasons I stated. The number one buyer. And this is in Bloomberg today about companies, but I've been pounding this for a year and a half. The number one buyer of the S&P 500 for the past year and a half has been the S&P 500, period. And mom and pop ain't putting the market up at these levels, and hedge funds and all the, quote, smart money have kind of been selling. Well, who the hell's been buying? Well, if I was the CEO of, Whiz Corp and interest rates were this low, I would borrow the hell. I'd mortgage the house and my mom to get money. I'd buy back my shares. I'd prop up my share price. There goes my bonus. A lot of good stuff. So a lot of this, inflated market that we've seen, as a lot of you have laid out, just doesn't correlate to the underlying economy. I agree with you, James. There's no way in hell we're going to see out of these PMIs like mysteriously that Caterpillar is, all their Tonka toys are out there building stuff, or our factories are cranking out products again, or anything like that. The data just don't support us being up here. But as we all know, the market and the economy are two completely different things. So I call this a hold your nose rally. I'll bid it up. I'm bullish. I'm like Anka. I'm bullish, but I kind of do the hold your nose, meaning I'm going to go get some protection, or at least I'm ready for somebody to yell fire. So I think after this most recent run up from that 50-day moving average and being back up here at last December highs, you really do. If I were a hedge fund manager and somebody threw $1 billion at me, or even less than that, and say, "Hey, put this to work," where. I just don't know where. I know you can't put it in your mattress. You can't go put it in a CD or bank account or any of those type of places. You got to put it in equities, Whiz. Well, equities are pretty overpriced here. So I think we take a break this week, and I'm saying with an 80 delta, that's going to happen. Now, of course, we'll have a rip your face off rally to Anka's 2030 level. So, and that'll suck. Okay, let's move on to question number 3. For your answer in question number 1, please share what specific reasons you think will be heading higher or lower. I know you sprinkled a lot of that and gave us a lot of your opinion already, but anything else you'd like to add, or anything based on you heard out of the three other folks?
Are you talking to me?
Yes, ma'am.
Okay. All right. So I'm basing my decision based on the very, very strong uptrend and based on the symmetry that I have, that I've seen on the charts lately happen. And I've seen that fundamental factors have played a very mild role so far on the charts, and it seems that the market has a mind of its own. And the fact that I saw this 2031 level, that was a projection, a calculated projection for the S&P 500 for the near-term future. And what I'm referring to for that particular area, in fact, is a consistent area of resistance, and it's a possibility for a move higher if we should break this 2100 level.
Can you share your charts again, Anka?
Okay, I'm going to try to do that. Okay. I hope everybody can see the charts right now. I don't have the projections drawn on this chart. I have a different. I have them on a different platform, and I did it before this show. Mm-hmm. So that being said, again, like I said before, we have to take it one day at a time. Let's not forget that we have a lot of data that is coming in, and but at the same time, remember that you once you are a technical trader, you have to pay very strict attention to technicals and technical analysis. And I'm not saying to ignore the fundamentals. Just keep an ear open for those, but don't be really focused on whatever's influencing the market, because otherwise you get really distracted from your method of trading. And I've discovered that like a long time ago, because when I first started trading, I was a fundamental trader, I was an institutional trader, and when I made the switch and decided to trade on my own, I've seen that more and more technical analysis works better than kind of like listening in to everything that's coming in. So overall pattern, we're very much bullish. We have been in a very strong uptrend. We are again on a top of the channel, on a top of an ascending channel, I would say right now. But again, I think that technical analysis plays a very important role here, even though we have low volume. But let's not forget one thing: when we have low volume in the market, and whenever we are either pre-holiday or post-holiday, we develop some really nice low volume mini trends that are happening. So let's not ignore that. I know the market is just kind of sideways and it's meandering in this area right here, and I don't think it's going to do very much today. But again, I mean, look at the technicals, I mean, look at the 4-hour chart. We've hit into this resistance point right here. We came back down into support, and now we're bouncing from support. So it's basically a level game, if you will. We're playing support, resistance, support, resistance. It's nonetheless, it's a day trading environment today, and I think it's going to be a day trading environment throughout the week.
I do. I think that sounds good, and I don't disagree. It kind of lays into some of the things that James was saying. I really think there's a lot of empty desks in Chicago, in New York, a lot of folks that are still, laying face down on the pool deck in the Hamptons, and starting this kind of dog days of summer. So I think it is a trading week. And Jim, I think you'd mentioned this, like, hey, if we don't take out today's highs type of thing tomorrow, then I think we do kind of go Titanic on this thing and slowly start to roll over, kind of like we're doing right now. I mean, Dow's down, what, 80, what's that, 80? S&P's down about 2. So, yep, I think it might be a week for trading. All right, James, how about yourself? Anything to add to what everybody else said, or anything else that you're seeing for this week that gives you your bias?
No, I think I think I pretty much summed it up before. You know, there's a lot of things that, in my opinion, add to the case for a down week this week. The fact that no one's really around, volume is thin, and you know, I agree with what Anka said there. When volume is thin, you know, that is when something that you might not expect to move the market a lot could. You know, if we do get a surprise to the upside in one of these data points between now and the end of the week, maybe that does move the market higher more than it should because volume is relatively thin. But I think that if we take a look at all the catalysts that we have this week, the fact that no one's really around to trade them, and the expectation that none of them are really going to be all that great is going to drag this market down, make it very difficult for it to rally, especially because we sold off today. I mean, don't get me wrong. I think if we were higher by 5 points in the S&P right now, I'd probably have a completely different opinion. But we also have some kind of micro data releases as well. More retail names reporting. We are near the end of the cycle, and those earnings haven't been great. You know, there's not a whole lot this week that I think we can look forward to and say, oh, well, that should be a really nice bullish catalyst for the market. And for all those reasons, I think we're heading lower.
Roger that. And Jim?
Yeah, just the bullishness technically might come from these moving averages. The 50 and the 200-day are crossed on a lot of the major indexes, so obviously that's a positive technically. But the 200-day moving average on the S&P is way down at 2010, and we're up near 2100, so that's about 5% above it almost. Other thing is with regards to 2110 and 2135, which are numbers that in my opinion, seem to have some significance. You know, the question is will they blow out those numbers and get all those shorts who might be above there to cover and then bring it down? Of course, that's a possibility as well. But we do know that the high points on the S&P at 2135, NASDAQ 5200, Russell 1300, transportation 9310, those highs have been around for quite a long time now. And some of these indexes are not that close to the highs in the first place. So, you got to be a little suspicious of this thing. We're getting closer to the election. You know, they brought it up here on some pretty light volume and pretty lousy breath. And when these guys come back, if there's major positions to be taken, you know, they have to feel comfortable that they want to take them through the election and fight some of the history of 2000 and 2008 and 1987, 88, where when we switch quarterbacks, some destabilization of the prices can happen. And indexes like China used to be 5,100, and they're trading at 2,800. So there's already been a significant correction in some of these other areas. So we'll have to see what goes on. But, I think, let the numbers dictate what you do is probably always the better way to go.
Agreed. I wouldn't add too much to what everything just said. I think we covered the battlefield pretty appropriately with what's going to happen or what is happening this week. And Anka said something very, very interesting, which is, instead of focusing on just one thing, like whether it's fundamentals or technicals or everything, in aviation it's called a scan. You can't stare at one instrument the entire flight or you're going to fly on the side of a mountain. You have to have a scan, a disciplined scan pattern where you look at, you give each instrument based on its significance, that amount of time and importance, and you move on to the next one. So I thought that was pretty interesting. So, okay, here's what I want to do as our final question going around the room here. I always like doing this one is trying to, because I'm cheap, I like to squeeze a free trade out of you. So whether it's a weekly trade, an hourly trade, one out to January of 2018, whenever it is, what do you like right now? What's a good trade you have on right now, or something that you would, we're not giving investment advice, that you would maybe potentially talk to somebody at a cocktail party about and say, hey, this is a pretty good looking trade. Anka?
So I'm looking at Yahoo right now, and I think that Yahoo has a possibility of a breakout, and this could be a possible swing trade moving higher with probably a target into the $40 area, $39, $40 area. And it's at the breaking point right now, $38.
Really? Yahoo. That one comes out of the blue. What do you think about their current management? Or what's the time frame on that trade? I guess I should
I'm
say.
looking at the daily chart, and kind of like the same pattern for BABA.
Mm-hmm.
Yes, BABA would probably be a safer trade than Yahoo.
Mm-hmm. Why is that?
Well, there was a lot of talk about Yahoo is in the news with the takeover, and so there's a lot of news going around it, and probably for that reason, BABA would be a safer trade.
I like it. Thank you, ma'am. That's I will. That one is approved. James, let's move on to you.
Sorry about that. I started to talk without realizing my microphone was still muted.
No
Anyway,
worries.
I think if someone is looking for a short setup this week, trading KORS Michael Kors ahead of earnings tomorrow or post earnings would be a pretty decent play. The stock has a really strong historical record on earnings day, and the stock is up today, which I actually think is a good signal for a short. As far as we can tell, options action and general flows in the actual stock have been pretty negative coming into this. Also, this is retail. This is retail that is, I guess, sort of on the higher end of the spectrum, and those names have not been doing all that well. Retail in general has not been doing all that well. So I think that's a decent short setup. If someone's really looking for a play to get long this week with some more shorter dated options, interestingly enough, some of the most active things I've been tracking today have been bullish positions in oil names. MRO Marathon, they are up to about 15,000 of these July 15 calls so far today, which is a huge amount of trading on a day like today where we're not really seeing a whole lot of action. They bought a ton of those, and they also bought some shorter dated June options. Give me a second to pull those up here. The June 15s are up about 11,000 of those now, and those are trading at like 20 cents. So someone looking for, expecting a breakout today or this week on thin volume might want to go with those. They're real cheap, have a small delta, but with short time to expiration and a decent amount of gamma for a trader for a very small amount of premium.
Like it. Sounds very nice. And Jim?
Yeah, well, at Option Professor, we don't really make specific trades on stuff, but I just want to throw a little bit of a macro thing out there because between the short-term trading, people do have longer-term positions that they're holding on to.
Sure.
And so just on a macro view, the S&P 500 clearly is up here against resistance. And as I alluded to, some of the other indexes are nowhere near their highs. So going into the next 6 months, 3 to 6 months, I would keep a real close eye on some of the indexes like the S&P and the VIX, the volatility measurement. And if you had any kind of a combination between under 2,000, which sounds like a long way from here, but we all know that 5% off the index can happen pretty quickly if circumstances change. And so if we were to get under 2,000 and the VIX started trading above 20, I would take the decline rather seriously because we've got a little numb. We had 2 drops down to 1,800 that were rebounded from. And I think the complacency on the rebound here is acting as if the moves to 1,800 never happened. And sometimes that mentality of complacency after you've seen a lot of danger, you being a pilot, you would know that, if you've hit pockets of rough air, you certainly want to be on probably talking to the tower about anything further ahead going to hit me again. And so, we hit some pretty good pockets of turbulence at the end of 14 and in 15, the beginning of this year. And so, in 2015 and the beginning of this year. And I think this move to 2,100 has everyone dismissing it as just a pullback, which may very well be true. If the one lady there is right, we're going to go out 2140, and keep going. Then obviously this time could be different. But if we start getting numbers that look like 2050, 2020, 2000, 1950, whatever, and the VIX starts jumping up, going into this new election, I'd probably at least be aware of how hedging works.
Makes perfect sense, Jim. And as an option professor, when vol's cheap, you buy it. When it's expensive, you sell it. So couldn't agree more. My shorter term trade here is Facebook. I think the huge gap up on earnings, and it's held that gap. Most stocks after they gap up like that a gap, not that I get smacked in the face often, a big gap like that is like a smack in the face. The stock afterwards kind of hangs out for a little bit, wondering, what the hell just happened, and should I be up here, should I not? And Facebook, if you look at the chart, has gone through the, I should be up here and head higher. It's down a little bit today. I have a weekly bull put spread on Facebook out to obviously Friday, but we've had, I think we're 9 for 9 in our most recent weekly options trades with Facebook. So I think it's a great intermediate or short-term trade, also intermediate, and absolutely uber long-term. I'd put Apple into the hey, I'm now Microsoft category, and I think a lot of that money really has rotated out of Apple for Facebook. And Amazon. So those are my tech picks. And finally, we took a look in our live trading session this morning at 9 a.m. Getting long the financials, or longer. We're long JP Morgan, we're long Morgan Stanley, we're also long AIG and the XLF. If you take a look at a chart of any of those over the past 3 weeks, there's been a near 60-degree climb angle on financial stocks, and hopefully everybody can figure out why. Well, Whiz, there was a market tantrum. Didn't the financials get hit? No, they were actually up, and the reason is because interest rates. There's kind of that Wall Streetism that says when interest rates are high, stocks will die. When interest rates are low, stocks will grow. That's kind of a good general statement, but not for the only exception to that is financials, because financials obviously want interest rates to go up. They want to make money. They push their own mother out of the way to pick up a buck, and for the past couple of years, it's just been ugly for them. So if you're looking for a downrange pass, a nice 50, 60-yard pass down towards the end zone, I'd get long the financials now before the Fed starts getting on their interest rate horse there. Okay, awesome. I'll tell you what, folks, Anka, James, and Jim, why don't you let all the folks know where they can track you down, what you do, and how to get a hold of you in case they want to learn more about everything we talked about today.
Okay, so thank you so much for having me here today. Guys, if you want to reach me, it's tradeoutloud.com or email me at info@tradeoutloud. I'm more than happy to answer your questions or to go over any of the products that we have, that we offer on our website. Thank you so much for having me. And have a great trading week.
Awesome, Anka. Thanks. You too as well. James.
Right, so we can be contacted at alphashark.com either via the contact form on our website, or any of the individual moderators of our trading room or myself can be reached via email on that site as well. A much quicker way, though, to talk to me about unusual options activity, earnings trading, or anything else that we do here at AlphaShark is to shoot me an email, james@alphashark.com. I get a lot of email, but I do my very best to respond to people's questions and comments within 24 hours. So drop me a line if you want to find out a little bit more about what it is that we do here.
Awesome, James. Thanks. And Jim.
Okay, Matt, thanks a lot for having me here again today. And for those who'd like to get more information, excuse me, on the educational DVDs that is available through Option Professor, simply go to the website, optionprofessor.com. There's 7 of them there. Starts with an introduction and goes through all the different strategies from both the use and the risk and how they work and how they don't work. And I think it's very helpful to the majority of people that are listening today. So do go to the website and try to check those out.
Awesome, Jim. Appreciate it. And as I said, my name is Matthew Buckley, call sign Whiz. If you're interested, you can go to, obviously, our website, topgunoptions.com, or if you're interested in taking a look at some of our services, our live trading and training services, you can head to go.topgunoptions.com/FTM. Foxtrot Tango Mike. That's Full Throttle Monthly, and you can take a look at what we do. We have live trading services, we have alert services, texts, emails, education, training every Wednesday night at 8. So we have a blast at TGO, and it's a lot of fun. And that is how you can track me and us down. So, okay. Other than that, folks, thanks for coming. After our holiday yesterday and in this holiday shortened trading week, I appreciate everybody's great stuff. I took a lot of notes, as a matter of fact, so I'm going to be looking at a lot of the recommendations or things that all these folks pointed out. So, David, thanks again, my friend, for having me and having such a great panel, and I will throw it back over to you.
Okay. Thanks. Yeah. Thanks everyone. Great show. Just want to remind everyone watching, we'll be back to our normal Monday schedule next week, and Lance Ippolito, John Thomas, Dean Jenkins, Henry Schwartz will be on, and Rob Hanna will be moderating. Just want to remind everyone also that you can go to TimingResearch.com and download any past reports or watch any past archives of the weekly show, including this one will be up in a few minutes. And so just want to thank my guests again, Anka Metcalf of TradeOutLoud.com, James Ramelli of AlphaShark.com, Jim Kenney of OptionProfessor.com, and of course Matt Buckley of Top Gun Options. Thank you for hosting again. Thanks, guys.
Thanks, David. Have a great day.